Hello and welcome to today's Office Hours presentation. This is Paul Hoyt. Our Office Hours presentation is a relaxed, informal mentoring program that we do every Monday at noon Pacific time. All these recordings, slides, and exercises are archived in our members area, and all these recordings are available on my YouTube channel at youtube.com/user/Paul Hoyt. The reasons we do these presentations is because being a successful small business owner can be a great experience, but it's also tough. You need to have the education, the training, the tools, and the team in order to be successful. And I want you to get to know me, because when you get to know me, you realize that I really do care about you. First and most importantly, I care about you, and I want you to have success in your life, whatever that means to you. I want you to find the greatness, the happiness, and the divinity within yourself, and then remember it, embrace it, and live it every day as I try to do. My passion is to increase the survival rate, accelerate the growth rate, and reduce the struggle rate of businesses in America. And my vision is to help millions of CEOs and entrepreneurs accelerate their business growth and enjoy greater harmony and balance in their lives, to really help them grow and thrive and blast past survive. And you can help by passing the word. So if you know a small business owner out there, please invite them to check out my Office Hours presentations on our YouTube channel, or sign up for free at paulhoyt.com to attend these sessions live in the future. Our agenda is typically an in-depth discussion of a business success principle, and then I offer closing remarks, special offers, and invitation for next week's session, and then we go into open questions and answers and coaching towards the end of the call. I invite you during the call to join us in the Brilliant Business groups on Facebook and LinkedIn, either in the call or if you're listening to the recording anytime. You can get to the Facebook group at facebook.com/groups/Brilliant Business. And if you're looking for the LinkedIn group, you can do a search on Brilliant Business Group or follow the link that's here on the slide at bit.ly/Brilliant Business Group. We did that because LinkedIn doesn't offer very intelligent or easy to type in URLs to get to their individual groups. I also invite you to join us in those Brilliant Business groups, because we offer a business success principle of the day 4 days a week, which I post both on Facebook and LinkedIn. And then I do an energy of the day posting on Facebook every day. I think we're up to number 460 now, where you can make comments, questions, and share your insights and takeaways. And if you haven't done so already, I invite you to like my business page on Facebook. Today's topic is on what's it worth, valuing your company. As always, we try to relate the subject matter of an Office Hours presentation to one or more of the key performance areas of business that I introduced in my book in 2004, The Foundation Factor. And this one's really about leadership and financial management. It's the responsibility, I believe, of the CFO to understand the value drivers of the business and be focused on the asset value of the business. But it's also the responsibility of the owner, the leaders of the business, the CEOs, the executives who are responsible for making sure that they are protecting and increasing the asset value of the business. In today's presentation, we have a very long agenda. We're going to talk about the reasons for you to get an evaluation, where you can get a valuation, definitions of value of a business, components of value, approaches to determining value, factors that affect the value of your business, some examples, and talk about valuing new ventures, because that's a little bit different than valuing existing ventures, existing businesses, and then we'll sum it all up for the bottom line. So let's get started. Why do you want to do a valuation of your business? Well, as it turns out, there are a lot of different reasons for valuing a business. Anytime that you have a change of ownership in your business, it's a good reason to get a valuation on that business. So as an owner comes or an owner goes, that you can fairly assess the current value of the business and set their ownership accordingly to that fair value. You may also decide that you want to raise capital, and whenever you raise capital for a business, it's important for you to know the value of a business today and the value of a business tomorrow, so that you can fairly represent the value of your business to any potential investors or current investors in the business. Sometimes when you go out and get a loan, especially if it's an unsecured loan, unsecured in terms of not being secured by specific assets of the business, that you may need to get a valuation of the business, or the bank or other lending institution may require you to get a valuation of the business in order to get the loan. Unfortunately, if you have a lawsuit against your business in some way, they may be required to get a valuation on the business and to support your position in a lawsuit or defend the position in a lawsuit. Anytime that you sell an asset, a portion of the business or specific assets within the business, you may need to get a valuation of the entire business. And if you have any sort of stock-based compensation, as it turns out, for when you have stock-based compensation, you're required by the IRS to get a formal valuation opinion every 12 months to avoid tax penalties. Because when you give compensation in the form of stock, you are essentially giving stock that has a taxable value to it. And if you want to avoid any problems with the IRS, you need to have a current valuation so that you can fairly assess the value of essentially the ordinary income that you're giving to people whenever you give them stock as a portion of their compensation program. Not true, by the way, if you're giving them an option. But if you're giving them stock, that is real tangible value and it is taxable, and you have to understand what that valuation is. There are a lot of different reasons, by the way, to change the ownership of a business that do require you oftentimes to get a valuation. Anytime you bring on a new partner, for example, if you have a partnership firm like a law firm or a CPA firm or a medical practice of some kind, when you bring a new partner into the business, typically that partner buys into the business. You may grant a little bit of it, but mostly they buy into the business, and you want to understand what the fair market value is or the value of the business by formula when you bring that new partner into the business. Unfortunately, sometimes partners go, and when they go, part of the buy-sell agreement may require you or the existing partners, the remaining partners of the business, to purchase the value from the partner who is departing. And hopefully they don't depart in terms of death, but sometimes you have to do a formal valuation of the business when one or more of the owners passes away so that you can properly value that to the estate. And it also happens in the case of a divorce. Whenever there's a divorce, typically the spouse will own some portion of it, half of the business typically, or some portion of it was covered by a prenuptial, and you have to value the business in order to properly give the departing person, the spouse who is not the owner of the business or remaining in the business, their fair share of the assets of the business. There are a lot of places you can turn to get a valuation for your business. There are two formal accreditations or certifications when it comes to valuing a business. The first one is the accreditation in Business Valuations, also called an ABV. And the second one is a Certified Valuation Analyst, which is also called a CVA. So if you're required to get a valuation for anything that has to do with a court of law, you generally need to get the valuation done from somebody who is certified to do a formal valuation of your business that will stand up in a court of law. And these are courses, by the way, to get an accreditation or a certification are courses that you have to take. They cost a lot of money. Generally, a certified valuation analyst is also a CPA who can get the certificate in addition to their CPA, but not necessarily. They could just be a business advisor who wants to get that accreditation so that their valuation can stand up in a court of law. So if you need to get a valuation for anything that has to do with a legal proceeding, my encouragement to you is to see about getting it done from somebody who has one or both of these certifications or accreditations. And in fair disclosure, I don't have either one of them. I know what they are. I've studied certainly the art and science of business valuation. But if you're looking for somebody to give you a much more qualified opinion, this is a very good place to start. You may also turn to a business broker. Most businesses, unless they have something of over $5 to $10 million in asset value, the transaction of selling a business or a portion of the business is handled by a business broker. And as it turns out, a business broker is really a real estate broker who in some states may have a special certification or training program, but in many states is just a real estate broker who is authorized to sell a business, because a business is considered to be real and tangible property, much like a home or office building is considered to be real and tangible property. So typically businesses with under, I would say, $5 or $10 million valuation, the transaction of selling a business is handled by a business broker. If it's $5 or $10 million or more, it's typically handled by an investment banker. And just like a business broker, which is a regulated profession, the profession of being an investment banker is regulated by FINRA. In the first case, in a business broker, it's regulated on the state level, just like any real estate broker is licensed and certified by a state authority. An investment banker is licensed and certified by a national or federal authority called FINRA, and they typically handle the larger transactions. So if you're selling your business, going to a business broker or going to an investment banker may be the right thing to do, and they can give you a formal valuation on your business. But also CPAs, attorneys, and business advisors like myself who have a considerable amount of experience in seeing businesses bought and sold, and the legal paperwork and the financial considerations thereby may be also able to give you a good estimate of the value of your business. Again, it's not a formal accredited valuation, but they can give you a good estimate of that. And one of the most important folks who can give you an estimate of the value of the business are investors themselves. And towards at the end of today's presentation, we'll talk a little bit more about how investors may value the business, especially if it's a new venture out there. There are a lot of different definitions of value. As it turns out, when you go to value a business, there are a lot of different types of value that you may get. There's the fair market value, which is the one we most oftentimes think about, which is what is my business worth on the open market if I went to sell my business. But there's also the liquidation value. What is the value of my business if I just decide to close my doors and salvage all the assets? What is the investment value of the business may be a lot different than the fair market value or the liquidation value if the business has a lot of strategic value to it, and which is the fourth category, which is the strategic value, which may be dramatically different from any one of these other values out there. And the last type of value of the business is the replacement or the recreation value. What would it cost me to create this business from scratch if I started today, which of course is a different value than any of those other values that we have out there. For any business, there are a lot of different components of the value. One of the most significant components of the value of business is the cash flow that the business is spitting off on a monthly basis. There are other liquid assets which add to the value of the business as well, such as the value of accounts receivable and any liquid portion of the inventory that you have. Fixed assets, such as longer-term valuations on inventory, cars, building, land, equipment, furniture, and fixtures that are within there are considered to be fixed assets and a portion of the value of a business, and the intangible assets of a business that we'll talk about in just a minute. And of course, whenever you're talking about the value of the business, it's not only the assets, but it's the liabilities of the business that detract from the asset value of the business and give essentially the net value of the business. Here's a little more information on the intangible assets of the business, because they can be your intellectual property, which is your patents, your trademarks, and your trade secrets within the business, and also copyrights. But other aspects of intangible assets may be your customer relationships, the value of your customer base itself, any contracts that you have in place, especially with suppliers or long-term customers, and any artistic value that your business might have, which is kind of a strange thing, but in some businesses, they will have some value on the art of the business itself, especially when it comes to the products that they have manufactured. There are different approaches for determining the value of your business. Sometimes it's the market value, where we look at similar transactions in the marketplace, much akin to valuing a residential piece of real estate or a commercial piece of real estate. We look at comparable values. We look at businesses that have sold, say, in the last 3 to 6 months, who might be similar in industry and similar in size and find out what the market value of those businesses were so that we can determine what the fair market value of a business is today. You may look at the asset value and the cost to replace, as we took a look at earlier when we talked about the components of value. Or you may look at the liquidation value, which is a quick salvage value. That's different from the asset value because the liquidation value or the salvage value assumes that you're going to sell the business in a fire sale. If you were just to shut the doors today and sell it as quickly as possible, that's the immediate liquidation value or the salvage value of your business. And in practice, we go through all of these exercises to determine the value of a business. We understand what it might be worth on the open market based on what other businesses have sold for. We understand what it might be worth if we were to sell the assets off in a timely manner, but in a manner that gave us the most return on investment. And we understand what the value is if we did a fire sale and sold it immediately. There's also the value of the cash flow, and there are a lot of formulas in terms of discounted cash flow is one of them, and other formulas that allow us to determine the value of a business based upon the cash that it is spitting off on a monthly basis. We may also determine the value of a business based on formulas, which may be a multiple of revenues or a multiple of earnings before interest and taxes, or the longer, a multiple of earnings before interest, taxes, depreciation, and amortization. So as you can see, there's a lot of different approaches to determining the value of a business. And just like that there are a lot of approaches to determining the value of a business, there are a lot of factors that go into determining the value of the business that are the components of the value. There may be external factors, such as whether or not you're in an expanding or shrinking market. You may have external factors which are largely out of your control, like global economic conditions, any legislation which has been passed or is pending, customer preferences, which are oftentimes out of our control, and advances in technology, which may be out of our control. If you're a technology-based company, you really have to watch the last factor there, which are advances in technology. You have to be on the leading edge or near the leading edge of business in order for your company to maintain its value over time. Otherwise, advances in technology from your competitors, which may be largely out of your control, can really be a detriment to the value in your business. There are a lot of things, however, that are in your control. There are internal factors, such as your financial results. Largely, your revenues and your profits are in your control as the leader of a business. The team that you have around you is a big factor in determining the value of your business, and that's in your control as well, as are your plans, your growth strategies, and your ability to execute those plans. Any intellectual property that you have, you can develop intellectual property and register intellectual property. You can file for patents and trademarks and copyrights, which will add to the asset value of your business. And there are things that you can do internally to make sure your business is in ship shape and will survive any sort of due diligence out there. So the quality of the records that you have, and really the overall quality of your organization, is a factor affecting the value of your business that is largely within your control. Other things which may affect your value are the appearance and the intuition. You may have somebody that comes in as a business broker or investment banker that has a sense of experience that they can only talk about in terms of intuition. They take a look at your business. They understand the look and feel of the business, the camaraderie of the business, the energy, the vibration of the business, and can add to or subtract from a valuation of your business based on that intuition, that factor that they can't quite put their finger on. Transferability of value is a huge factor. If you go to purchase a business today, one of the things you want to make sure is that the value that was there for the previous business owner will be there for you as a new business owner, that the people are going to stay with the business, that the customers are going to stay with the business, that you're going to be able to learn enough about the business and in order to operate the business with the same sort of success that the previous ownership did. In other words, is the value that was in the business for the previous owner going to be there for you as the new owner? Can you effectively transfer all of that domain experience, the customer relations, the employee relations, the supplier relationships from the old ownership to the new ownership? Another one is your ability to make the business more profitable. So you may go take a look at a business and say, you know, they're making some pretty good money today, but they have a tremendous weakness when it comes to marketing or sales effectiveness. And you know, with your experience in marketing and sales, that you could come in and spruce that up and make that business even more profitable tomorrow than it is today. Well, that's something that will affect the value of the business in your eyes, because you see an opportunity to make the business much more valuable tomorrow than it is today through your own expertise. Another factor that affects value of a business is the leverage value or the loan value. Private equity firms will oftentimes borrow a significant amount of the money that they need to pay for a business from a traditional banking institution, which allows them to leverage the equity or their own money that they put into a company. The greater the leverage, the greater the value it is to them, because the less capital of their own money that they need to put in and to buy the business. We may give an example of that a little bit later on, but the leverage value of the business depends entirely on the cash flow of the business. And if the business is cash flowing a lot, it means that somebody who wants to acquire your business can borrow a significant amount of the money that they need to have in order to buy your business from a traditional lending institution, which gives them a tremendous amount more leverage on their own money that they put into the business. Other factors that affect the value of the business is the risk. We'll talk a lot more about the risk factors in a second. But another one is the stage of business. So ideally, well, let's talk about the risks first, and then we'll talk about the stage of business and how that impacts. There are a lot of different risks whenever you go to buy a business or go to value a business. There can be execution risk. Execution risk is related to what we talked about earlier with the transferability of the value of the business. Are you, as the new owners of the business, going to be able to execute the business with the same or greater effectiveness than the previous owners have? Is there economic risk? Do we sense that we're coming into or out of a recession so that there's some economic risk associated with this industry and with this specific business? Is there a competitive risk? Are we at risk because we're not at the leading edge or the bleeding edge of our technology, that some competitor will come forth and put together an offering that really determines or really detracts from our competitive value? Is there legislation risk? Is there legislation pending right now, or you expect there might be in some time in the future, which will impose new government sanctions or government regulations that will cost money and cause the business to be more risky? If the business has not been started yet, is there production risk? Or if the business is going to expand, is there production risk? Can we really grow the business the way we want to grow the business? Do we have suppliers lined up who can grow with us? Or is there a considerable risk when it comes to the expansion of a business? Is there risk in getting funding that's necessary to expand the business or start the business up? And is there market response risk? Market response risk is typically only a risk of startup businesses who are not proven in the marketplace before. But funding risk and market response risk are huge risk factors for companies that are not already profitable. And for any company out there that's a high-tech company, there's always the technology risk. The risk that the technology that we have employed in building our products and services will be obviated, will be discounted tremendously by advances in technology over time. I also talked earlier about the stage of business. Ideally, when you purchase a business or value a business, you want it to be on the uptick. You want it to be somewhere in the growth process and headed toward maturity. You don't want it to be in the mature stage or the declining stage unless you see significant value in the customer base and the ability to, say, resurrect the business with a new product line that will take it out of a declining stage into a growing stage. That's why, by the way, one of the reasons why so many businesses did not go on the market from 2009 through 2012, because they were in a very flat growth mode or even the declining revenues based upon the recession. And you paint a much better picture. You get a much higher valuation multiple if the company's in a growth stage. If we made more last year than we made the year before, and we plan to make more this year than we made last year, etc. Companies may also have strategic value that's far beyond the book value or any of the other factors that we've talked about. The strategic value of a business may give the acquiring business a significant increase in market share, which gives them more brand awareness, which increases the value in significant ways beyond just the cash flow value or the intellectual property value or the hard asset value of a business. The value of the customer base may also be strategic. So if I, for example, am selling shirts, I may want to buy a company that primarily sells jeans with the idea that I can sell my shirts to the customers who bought the jeans, and I may be able to sell my jeans or the new jeans to customers that previously bought the shirts. There's significant strategic value in the customer base because of the products and services of the acquiring company. You may also want to do it as a competitive buffer, which means that you want to buy the business before your competition has the ability to buy the business. That's why Google bought YouTube several years ago for $1.6 billion, even though YouTube had no revenues at all at the time. The industry analysts believe that the primary reason that Google did that was because they didn't want Microsoft to buy that business. They bought it as a competitive buffer. And we see Microsoft buying businesses and Apple buying businesses and other high-tech companies buying businesses for their patent portfolio, which is the next reason, the patents and the intellectual property, and they also didn't want their competition to own those patents and that intellectual property. So by far, if you can get somebody to see the strategic value in their business, you may enjoy a value to your business that's far beyond normal formulas, far beyond the normal formulas for multiples of revenue or multiples of earnings if they see the strategic value in it and they don't want their competitors to enjoy that strategic value. So here's some examples. We're going to take an example, take a look at a high-tech company, at a product company, and at a service company today to talk about the different factors that are involved in their value. With a high-tech company, one of the primary considerations of value is the intellectual property itself. It's the secret sauce. It's the trade secrets. It's the way that you do things, that nobody else does things, that gives the purchasing company a value that they couldn't get otherwise. The team in place is very important. As you'll see, it's important with all different types of business. But oftentimes, a high-tech company may get acquired for the strength of the team itself. Google has been buying up a lot of businesses here in Silicon Valley, and rumor has it that the way that they seem to value it is $1 million per very sophisticated technician. So if you have a high-tech business that's created a great product, even if you don't have any revenues at all, Google may value you based on $1 million per highly proficient, extremely sophisticated, genius-level team member that you have. Again, a high-tech company may be purchased as a competitive buffer because of the strategic value of that, and it may be purchased because of the time to market. If you see that somebody has a head start in creating a product, whether it be a software product or a physical product, you may decide that the time to market is extremely valuable, and it's much more, makes a lot more sense for you to buy a company that has a head start, even if it's just 4 to 6 months head start, because time to market is such a big factor in a high-tech company. The first mover's advantage is an extremely powerful advantage to anybody in the high-tech world. You may also buy a high-tech company based on the customer base alone, the people that it's attracted to it. And primarily, high-tech companies are purchased on strategic advantage. They're not necessarily purchased on the revenues and profits that they have today, but they're purchased primarily based upon strategic advantage. And that's why they're valued at so much. They're valued at multiples of earnings that can be in the 30, 50, or 100 factor, and sometimes they're purchased based on a significant strategic value when the company's not in revenue at all. Product companies are a little bit different. Product companies are based primarily or valued primarily based on cash flow, the customer base, the intellectual property, and the inventory and other physical assets that they may have. So whenever you have a physical product that is brought to market, and sometimes this relates to software products too, or digital products, but primarily physical products, it's a different way of valuing a business. It's based on cash flow, customer base, IP, and inventory, and may also be based on brand awareness. So a product company like Coca-Cola is primarily valued based upon the brand that they have, not necessarily the cash flow or the intellectual property that they have. Generally, product companies are valued on a multiple of earnings, with the assumption being that the assets that they have, the intellectual property that they have, and the physical assets that they have are the things that are generating the value of that business and are valued based upon a valuation multiple. Here's a slide that we offered in a couple of office hours presentations ago on how much your company is worth. And the important thing about this is that small companies may be valued at 2 to 4 times revenues, or EBITDA rather, but larger companies may be valued at 5 to 7 times or 6 to 8 times. So that's right. Not only is your company value increased as your revenues and your profits increase, but the valuation multiple is also increased. That's one of the reasons why private equity firms execute a strategy they call a roll-up strategy. So they may buy 5 or 6 printing firms, for example, focus them under a central brand, reduce the operational overhead by centralizing some of the operating expenses, and the company that is resulting may be a $20 million company instead of 4 or 5 $2 million companies. And if that's the case, then not only has the revenue and profits increased, but the valuation multiple has increased as well. The reason is because there is an implied advantage to being a larger player in the marketplace. You have a little bit more elbow room, a little bit more ability to impact your valuation and your results if you're a little bit larger player in the marketplace. A service company is valued much different. A service company is valued based upon the customer base, the cash flow, and the brand awareness, and is primarily valued based on a multiple of revenues as opposed to a multiple of earnings or the strategic value of a business. A service company is seen strictly as something that spits off cash. And primarily that's because service companies don't have a lot of hard assets. They may have some intellectual property assets, but they almost never have inventory or substantial amounts of accounts receivable, which would make it a company that would be valued more based upon the EBITDA or the earnings of a company. So those are some of the ways in which we value different companies based upon whether they're a high-tech company, a product company, or a service company. As it turns out, valuing new ventures, if a company is just getting started and doesn't have a lot of revenues or profits, there's a lot of different considerations for those too. And this may be of special interest to you on the call who are just starting your business and thinking about raising capital for your business. We're going to talk about several different ways that investors may value your business. We'll talk about the Harvard method, the Dave Berkus method, and the scorecard method. So first is the Harvard method. This is the one that's most typical out there. It's also called the venture capital method. It's where you estimate your earnings 3 to 5 years out. You determine an appropriate multiple for those earnings to project the acquisition value of the business, again, 3 to 5 years out, and then you discount it to the current point in time in order to determine what the current value of the business is at a particular discounted rate. Here's an example of that. Let's say that we have a company where the earnings of the company are projected to be $100,000 3 years out. The revenues of a company, by the way, might be anywhere from $800,000 to $1.5 million in order to get that earnings projection of $100,000 in 3 years. Because the business is rapidly growing and because it's in a high-tech sector, we may decide that the valuation of that business is a multiple of 5. which means that we think that the company that we're starting today, which has zero revenues, might be worth $500,000 in 3 to 5 years, and a 50% ownership of that business in 3 years or so would be worth $250,000 today. So if a company invests $50,000 today for 50% ownership in the business, then their value at 5 years from now would be $250,000, and they would get a 500% return on the investment, which, by the way, sounds like a pretty darn good deal to you and me, but not necessarily to a professional investor. Professional investors may be looking for opportunities where they can get 10 to 14 to 20 times their return on investment as a possibility, because they know that any startup venture is a high-risk venture. So they may be looking for something that's 10 to 15 to 20x return on investment, and frankly, they may not even be interested if you're projecting to them that they could get a possibility of a 5x return or a 500% return on the investment. Another factor in the Harvard method is that this assumes no dilution. If you're going to have multiple rounds of funding, then the sophisticated investor will understand that this particular example assumed no dilution, and they may want to factor dilution into their plans whenever they're assessing their ability to get their principal back and to get any sort of return on investment. There's another very interesting method for valuing startup businesses called the Dave Berkus method. Dave Berkus is a very popular and well-known investor in Southern California, and he came up with his own method for valuing businesses, which essentially says that we're going to value a business based upon the progress that they have demonstrated. We're going to give them $500,000 if they got a sound idea. We're going to value the business at another $500,000 if they've already got a prototype and it's out into the market and we're starting to get market feedback. We'll give them another $500,000 if they've assembled a quality management team, another $500,000 if they have established great strategic relationship, and another $500,000 if they really actually rolled the product out and they have some sort of revenues. This is a very interesting thing because it does cost money to come up with a great idea and vet that. It does cost money and time to build a prototype. It does cost money and time to build a quality management team, to develop quality relationships, or roll out a product. And he says, let's base the valuation on a company that we might invest in based upon their progress. And this is the maximum valuation. So generally, one of the I would say concerns about the Dave Berkus method, one of the complaints about that, and one of the criticisms about it is that his maximum value for a company is only $2.5 million, where most times you can have a valuation of a company that has achieved this kind of status up in the $5 or even $10 million range, depending upon what the level of sales they have is and what the market opportunity is. But for Dave, the maximum value that he'll ever give to a startup venture who is coming out for that first round of funding is $2.5 million. There's a third method which is starting to become much more popular called the scorecard method. And in the scorecard method of valuing a new venture, we take a look at average pre-money valuations that we have had before. We give the strength of the management team a rating of 0 to 30%, the size of the opportunity 0 to 25%, the product or technology 0 to 15%, the competitive environment 0 to 10%, the marketing sales channels and partnerships that are established 0 to 10%. If there's a need for additional investment, 0 to 5%, and if there's some other need, 0 to 5% as well. So we come up with a scorecard that says, based upon the other companies that we have seen, this target company may have a stronger team, may have a little better opportunity, may have a product or technology that's equal to the ones that we have seen, may have a tougher competitive environment, so we're going to cut them down a little bit on that. They haven't quite established the marketing, sales, and partnerships that we would like for them to, or that this comparable venture had, so we'll put them down a little bit based on that, but we'll rate them the same in terms of need for additional capital and other factors, which says that this current venture should be valued at 115.5% of a similar venture that we may have invested in just a few months ago. This is a rather sophisticated method that I've seen multiple angel groups do, and typically this is not an individual investor thing, it's an angel group thing where people will come together and determine what they think the fair market value of a system of a business is based upon the valuation that they've given to other businesses and how this business measures up, what its scorecard is relative to the other ventures that they have invested in. So here's the bottom line. Valuing a company is both an art and a science. There are a lot of ways to value a company. There are a lot of people who can help you value that business, and there are a lot of factors in valuing a business. Every leader of a company needs to understand the value drivers and be focused on them if they are, in fact, at all interested in increasing the asset value of the business and getting a return on their investment when it comes time for them to back away from the business or sell the business. So that was the bottom line. Our agenda for today was that we wanted to talk about the reasons, where to get the valuations, the definitions of the different types of value of business, the components of the value, the approaches to determining value, the factors to affecting value, gave you a couple of 3 examples, and we talked to you about valuing new ventures. So here's your homework and your exercise. I invite everybody who's listening to this recording or live on the call to project the value of the business that they have today and what they think that it might be 3 to 5 years out. Determine your most critical value drivers and then develop a growth plan that will increase your value over time so that you can enjoy an increased value of your business 3 to 5 years out. And as always, get coaching and support to help you manage that process if you need it. And speaking of coaching and support, we're going to go into questions and answers and coaching in just a minute, where we'll take a look at your comments and your questions on the topic of the day first, and then any other issues that you want to address. Tell me what your biggest takeaways are and what insights that you may have gained from the presentation, and tell me what you're going to focus on. Here at the Hoyt Management Group, our support services include education, training, consulting, and coaching services. We have a do-it-with-you approach to growth management. Some of the services that we provide teach you how to do it for yourself. Sometimes we do it with you, and sometimes we do it for you. We put fingers on the keyboard and help you write business plans, create financial models, create sales scripts, design the product funnels, do all kinds of different things in order to help you grow your business. We're announcing a new program a few weeks ago called the Awakened CEO System. In fact, we're taking my entire product portfolio and rebranding it under the Awakened CEO System. It's for those who are not only building a strong business, but also who are focused on becoming the person that they want to be. Stay tuned for some introductory webinars and coaching calls that will be coming up in the next week or two, and call me if you want any more information right now on the Awakened CEO System and the various programs that we have. Next week, on Monday, March the 2nd, I'm going to be talking about forming great agreements, because that's one of the most important things that a business can ever do, is focus on getting great agreements in place. And as always, let me know what topics you would like for me to address at paulsurvey.com. And in between now and the time we meet again, do your homework. And with that, we'll open it up to questions and answers. First, questions or discussion based upon the topic of the day, and then we'll open it up to any other thing that you want to talk about. Stephanie, do we have any questions or discussion points on today's topic?
We do. Can you give an example of valuing a service company?
I will talk about that because I think it's curious. I almost put a slide in the presentation today about valuing a service business versus valuing a product business. But let's say that you come to me and say, Paul, it's time for me to exit, that I have a consulting business and I want to transfer that all to you. I'd like to sell my consulting business to you. One of the ways that I can take a look at that is to say, great, this is like a $500,000 book of business. What is that $500,000 book of business worth to me this year, next year, and the year after that? One of the ways I can determine that value is to say, what would it cost me to go get that business for myself? And typically, customer acquisition is in the 25 to 30% range for revenue itself. So if I want to go get $100,000 worth of business, it may cost me $30,000 or so to go get that, 30% of the business. That's a typical customer acquisition cost. 25 to 40% is a typical customer acquisition cost for a service business. So I take a look at this $500,000 revenue stream that you're offering to sell to me, and I look and say, wow, that might be worth 30% to me in the first year, 25% in the second year, 20% in the third year, and so on. So at the end of 3 to 5 years, it may be worth 100% of the revenue value of that company to me over time. As it turns out that we want to pay for that over time. So I may agree to pay you 30% of that value in year 1, 20% in year 2, and another 20 or 30% in year 3 in order to get up to the 90 to 100% of the revenue value of the business. Typically, service businesses are valued at 90 to 115% of the revenues of the business based upon whether or not that revenue sticks around for a long time. In other words, if you have a large lifetime value of a customer, or whether or not the revenues are increasing, so that if you picked up the value of the new brand that you might expect to even increase the value over time. But typically they're also paid out over a period of time. So it's not uncommon for somebody to purchase a revenue stream like that and pay 30% of that revenue stream the first year, 30% of the revenue that comes from that customer base the second year, and 30% of the revenue that comes from that customer base in the third year, because that's how much it would cost them to go get the business on their own, and they don't have to put all the time and money into that. It's just being handed to them. Hopefully that was a bit of an explanation about why service businesses are valued as a multiple of revenues and why that multiple of revenue is typically 90 to 115% of the revenues that the service business enjoys. Hopefully that made some sense to you out there. Stephanie, do we have any other questions?
Yes. How do you monetize and leverage your intellectual property?
How do we monetize and typically intellectual property is valued based upon the revenue that is generated from that intellectual property. So if I have a service business and I have some secret sauce, say that, secret sauce in terms of the way that I write sales copy or marketing scripts or design landing pages that increase the conversion ratio of people, or some secret sauce that somehow helps my customers survive and thrive more than other customers. Generally, that intellectual property at a service business is based upon the revenues and the profits that are generated by that intellectual property. So the fact that I have some really great consulting systems may or may not be valuable to somebody else unless I'm able to demonstrate that I'm actually able to generate revenue and keep customers around based upon the intellectual property that I have created. It may also, with product companies, by the way, I think intellectual property is valued more on the licensing value of that. So if I can license a patent or a particular trade secret or a process to somebody else, then that might be worth quite a bit, because you can license a really strong piece of intellectual property for 3 to 5 to 7% of the revenues that's generated with that intellectual property. So there can be the license value and there can be the profit and revenue value that comes from that intellectual property. But the bigger thing that you can do is, if you have intellectual property at your company, you may increase your own revenues and profits by leveraging that intellectual property through things like certification programs and training programs and dealership programs and authorized representative programs where somebody's been trained in your intellectual property, which allows them to use it in their business, and essentially you're getting royalties or licensing fees as a revenue stream, not necessarily as an asset stream, but as a revenue stream based upon your business. So a good strategy for me or any other service provider out there is, number one, to develop our intellectual property, find ways to generate significant amount of revenues with the intellectual property in our own business, and then find ways to leverage that intellectual property by helping other people generate revenues in their business through training them on the use of that intellectual property and licensing it to them so that they can use it and we can enjoy royalties based on that intellectual property. Hopefully that was helpful to you. Other questions, Stephanie?
Yes. Can you give us an example of the Harvard method? Oh, I'm sorry.
Yeah, we did that in the
I
context.
think you answered that already.
Yeah.
Well, I have another question.
Okay.
You mentioned leveraging and I'm sorry, monetizing contracts and customer relationships. What about databases? How do you value customer databases that you have?
I think they're valued a lot. And in fact, when I moved to Silicon Valley 7 years ago, I heard somebody say that whenever you have a startup business that is not generating revenue yet, that everybody that you have in your membership program or who regularly visits your website is worth about $1,000. So if you had a website that was generating 10,000 visits a day to your website, that business might be worth $10 million based on $1,000 per the average daily visitors to your website. That was an interesting formula that they used. So there's a way of valuing, the attention that you're getting in the marketplace, even if you haven't found a way to monetize that attention in the marketplace quite yet. If you have a database, I think the database is part of your intellectual property, your customer lists, so it would be valued in the same way that intellectual property is valued. If that is the ability of that list to generate revenues. Because some lists that you have are very cold, they can be dormant. You can send an email out to 1,000 people on the list, but only one person will open it up. But another person may have a list that's very active, and they enjoy a 10, 15, or even a 20% open rate on any emails that they send to their list. So lists themselves, having a list, I think is probably best valued based upon the activity of the list and the revenue that that list is able to generate for the company that owns the list. But it's definitely worth something, that's for sure. Next question, Stephanie.
Why are there so many different methods of valuations, of evaluating your business for angel investors?
I think every angel investor group, and probably every angel investor out there, likes to play the game of investing. And it is quite a game. It's a science, and it's an art, and it's a little bit of fun. I mean, typically angel investors, very sophisticated investors, this is their play around money or their knock around money. They're not putting, anything more than 10 or 15% of their total overall assets in speculation like this. They've got other things that they've done with their money. They bought, mutual funds and stocks and real estate and made other kinds of significant investments. Investing in new ventures is a high-risk game, and they know it's a game, but it's a game they like to play. And much like, betting on the ponies, where you decide that, it's the size of the horse or the way that they've run in the last 3 races that's going to determine whether or not you're going to bet on them in this race. Every angel investor, and especially every angel group, they like to get together and play the game of, can I find a winner? Can I find the winner? And how do I judge whether or not a company is going to be a winner? So they come up with their own ways of valuing businesses, and they come up with their own ways of determining whether or not this is a venture that they want to get involved with. We see that on the Shark Tank. Even in the context of the Shark Tank, with their 4 or 5 different sharks, each one of them has different ways of taking a look at a venture out there. One of them will like ventures in the fashion industry. Another one will say, I don't want to invest in anything unless it's got a hard asset with it. Each investor and each group of investors gets the opportunity to play the game of angel investing in the way that they want to play the game. And so each one of them gets to determine how they want to value businesses and how they want to evaluate businesses as to whether or not they can be a good investment for them. It's a fun game to play. It's a risky game to play, but it can be incredibly rewarding when the guy that you bet on or the business that you bet on turns out to be the next Facebook, Google, LinkedIn, or Twitter, and gives you 100 or 1,000x return on your investment. I mean, that's why we're really doing it. We're swinging for the fences in the hopes to hit a grand slam home run. Other questions? We got time, I think, maybe for one more, if you have one more, Stephanie.
Well, actually, there is one more. This woman is asking if you can help her determine some ways to increase the valuation of her business. It's a service-oriented business. Yeah,
absolutely. I'd be happy to have that conversation with her. And anybody that's listening to the call, you know, I've been around a long time now, 13 years or so, in dealing with small businesses. So I'm happy to have a conversation with you on what your value drivers might be to help you set your vision for what you want your company to be like in the next 3 to 5 years, what you want your activity level to be, what do you want to be doing on a day-to-day basis, help you figure out where you are today, and help you develop a plan to reach those goals, whatever those goals may be for you. That's what we call the Awakened CEO growth process, determining what your vision is, determining what your current status is, helping you develop a plan to get you from where you are to where you want to be, help you gather the resources necessary to execute that plan. Sometimes it's capability and experience in team members, and sometimes it's funding, and then walk with you to help you implement the plans and execute the plans that we help you create. So that's you know, an honor and a blessing to me to be able to help business owners out there just like you increase the value of their business over time through the employment of my Awakened CEO growth process. And with that, I think we will call the office hours session for today complete. Thank you very much for attending. Thank you very much for listening to the recording. This is Paul Hoyt, and until we meet again, have a most marvelous and prosperous day. Bye-bye.